Hey, thank you, Gio, again for joining us on this. I'd love to hear, a little bit more about you and the firm and your specialty here in short-term rentals.
Yeah, our firm is GoJo Accountants. We're a fully virtual tax advisory boutique firm. We support real estate investors and specifically with short-term rentals. And we have expertise and specialty in short-term rentals and how they relate to long-term rentals and other elements to your portfolio. So yeah, that's something we do on a daily basis.
Great. So I guess first, a question a lot of people have is kind of like, how do short-term rental taxes differ from long-term rentals?
Great question. So the difference is predominantly in how it's treated from an income tax standpoint. So most people think that a short-term rental would automatically be reported on Schedule C because it's treated more or less like a motel, right? When you're managing an Airbnb, some sort of a short-term rental virtually, it could be construed as self-employment services to the business subject to payroll taxes, right? That's what self-employment taxes are. But for it to rise to that level where that short-term rental is generating self-employment income, you need to be providing substantial services. So that would be providing services that go above and beyond what a typical landlord would provide for rental, whether that be a long-term rental or a short-term rental. The types of activities that would rise to substantial services would be providing chauffeur type services, maybe touring a region. If you have a grouping of short-term rentals, let's say in Miami, Florida, and you want to market to international tourism and you want these tourists to come in and then you kind of take them around the area, show them to all the hot spots, that would be generating self-employment income, even though the primary business would be operating that Airbnb short-term rental. But typical sort of day-to-day things like, maintaining the property, landscaping, turning the unit over, as long as the short-term rental has 7 days or less in average turnover, and those are the top level of activities that the taxpayer is providing to the short-term rental, it doesn't rise to the level of self-employment income and it wouldn't be considered a substantial service and it'd be reported on Schedule E instead of Schedule C.
So how about with like 1031s? How do they differ? Do they differ with a short-term rental versus a long-term?
Great question. And they wouldn't. Short-term rentals and long-term rentals, they're both considered to be used primarily for business or investment purposes. And they're both real property. So those are the primary criteria that you look at when looking at a 1031 exchange. So if you purchase short-term rentals back in 2018 and they're fully depreciated or significantly depreciated and have also appreciated in value, you can go ahead and do a 1031 into a long-term rental and it's perfectly fine, and or vice versa. And one other thing I want to mention regarding the short-term rental versus long-term rental in terms of depreciation is how they differ in terms of the amount of years you have to depreciate the property. So in terms of a short-term rental, if there's 30 days or less in turnover, you would depreciate that property over 39 years because it'd be like considered a commercial property like a hotel or a motel. And then if you had over 30 days of turnover, the IRS looks at it as a standard traditional long-term rental and it would be depreciated over 27 and a half years. So some little nuggets there that are something you want to consider when investing in these properties. Now, Angelo, from a financial planning perspective, how do short-term rentals and long-term rentals differ from an economic standpoint?
So there's quite a few differences. One thing is you will typically see a bit more income or quite a bit more income off of a short-term rental, but it can be very seasonal. So there's going to be periods of time where you're making great money, but then let's say you got a Jersey Shore rental. Once Labor Day comes and goes, you're not going to be able to keep those rents at the same level. So you'll have to do a bit of a cash flow analysis to see, okay, during those off months, what does it look like? Am I able to cover the bills with either less occupancy or lower rents throughout? Another kind of risk when it comes to short-term rentals is when there's an economic downturn, one of the first things that people tend to cut out are vacations. So in the event of a downturn, do you have like the cash to insure against if you get less people renting out your unit? Or are you able to maybe switch it over to a long-term rental and still be able to cover all of the bills on it? Another thing that we're seeing is a lot of regulation risk, where a lot of cities and towns are putting in regulations on how you can use your property, if you can use it as a short-term rental. And a lot of them are even requiring permits. So like, for instance, in Jersey City and Newark, you need a short-term rental permit in order to run it. Of course, it costs money because the cities always have to get their cut of the profit. And then another big thing is like the time investment in it. You're obviously having more turnover. You got the marketing going on. You have to be coordinating the cleaning crews and all of that. So it's not passive like with a long-term rental where your tenants in a long-term rental, you expect them to keep the place clean and you should be doing your at least biannual inspections on a long-term rental. With a short-term rental, it's it's constant cleaning and turnover. Now, in addition to that, with a short-term rental, in order to stand out from the pack, because that's what you want to do, you put your thing up on Airbnb or VRBO, and in order to stand out, you might add some things like I'll give you an example. I'm staying in an Airbnb with some of my buddies in August for my friend's bachelor party, and that Airbnb has a hot tub, sauna, kayak. There's even a little putting range there. So all of that is added expenses that, hey, you're adding more activities to your short-term rental in order to bring people in. So that's another expense that you want to make sure that you're staying ahead of the competition. Now that ties into, of course, insurance, where you're going to have to disclose to the insurance company that it's a short-term rental. And with adding in all those, fun things like a hot tub or kayak, there's way more risk for someone to get hurt. So that'll typically mean that your premiums are going to be higher because you're providing those services. So that is something that you would want to do to check in your underwriting to make sure that, okay, yeah, financially it still makes sense.
Wow, that's a ton of considerations. So essentially, to summarize from a financial standpoint, when assessing investing in a short-term rental, you want to look at, hey, can we generate a sufficient amount of ROI to justify the increased labor, actual personal hours that are being factored into it, in addition to the increased overhead costs attributed to it, like you said, with occupancy taxes and increased services to attract customers into your short-term rental. You have to essentially do that economic analysis on the front end. Otherwise, your cash flow could be depleted and you're stuck levered up and et cetera.
I mean, so, you can hand it over to, there's property management companies that specialize in short-term rentals, but that's cutting into your profit, and you're still going to have to be making some decisions. Hey, yeah, okay, this expense that needs to get done, or, oh, this needs to be replaced. So even if you do hand it off to a property management company, you're still going to have to be making some executive decisions on it.
True. And a caveat about that, if you do hire a property management company and you have a short-term rental, but your intention is to be a material participant in the short-term rental to leverage the short-term rental loophole, you can't hire the property management company because it could be construed that you weren't managing it yourself, right? You're outsourcing that. So yeah, it's another qualitative factor in the overall analysis.
Yeah, 100%. You got to make sure that you're following the IRS guidelines on that in order to get the tax benefits that you were expecting to get.
Exactly. Yeah, because the tax benefits, I'm sure, going to factor into the economic analysis that's done to even make the determination if it makes sense to go ahead with the investment.
Exactly. Because, I mean, like I said, you tend to get more cash flow off of the short-term rentals. But if you're really looking to utilize that short-term rental tax loophole, you want to make sure that you can provide to the IRS that, hey, I materially participated, document all of it, document. That's the word of the day.
So retirement accounts and how they relate to real estate investors, how do they factor into the overall game plan from a tax standpoint? And it's a little tricky because you see full-time real estate investors, let's say they're, whether they're pursuing short-term rentals or long-term rentals, regardless, if you're not providing substantial services in the case of a short-term rental, you can't generate earned income. Earned income is necessary to contribute to, IRAs like a Roth IRA or a traditional IRA or a simple IRA in the case of self-employed individuals. And then solo 401ks or 401ks are probably the easiest and the most efficient way to get the most money into any particular retirement account in any year. But with real estate, all of that positive taxable income you may earn after accelerating all that depreciation in the beginning that you're going to see in the middle to back end of the investment horizon of that particular real estate investment, you're going to be earning positive taxable income, but you won't be able to contribute to retirement if that's something you're looking to do, if you want to diversify. Angela, I'm sure that's something that you're talking to your clients about all the time, is the sort of the mixing and matching the pieces of real estate with sort of financial investments, right? So that's always a tricky thing. What have you seen in your experience with that?
So a lot of people often ask about like, oh, hey, I heard with a self-directed IRA or self-directed 401k, I can invest in real estate, which you are able to do. There are some caveat to that. With a 401k, let's say you put money pre-tax into a 401k, you can buy a rental and utilize leverage on it. You can use leverage or debt in an IRA as well. However, you do have be stuck paying taxes, and I'm sure you see this pretty often on the portion that can be put towards the debt, the leverage on the property. So that's something that you definitely want to be aware about. And then another thing that it comes down to is real estate is already so super tax advantaged, where does it make sense to put that into a retirement account where you're deferring the taxes, or you're putting it into a Roth account where it's going to come out tax free? So that's one of the things where pretty often it doesn't make the most sense to put directly held real estate into a retirement account. If you want to diversify into real estate in your retirement account, sometimes like REITs, real estate investment trusts, those can be a good option, just because with the dividends that REITs pay out, let's say you had it in a taxable account, that's going to be taxed at ordinary income tax rate. And then REIT income also does qualify for the QBI, qualified business income. So you can deduct up to 20% of the income from the REIT in your taxable account. But shifting back over to retirement accounts, all of those dividends, everything's all tax deferred or tax free. So that would maybe make more sense to put into a retirement account, while your directly held real estate, you don't put into a retirement account.
So in terms of asset location, it sounds like hard real estate assets, direct interest in real estate should be held, directly or in partnerships, tax partnerships, and then REITs, those should definitely be held in tax deferred or tax free accounts, Roth accounts, like you said, to maximize benefits on both fronts.
Yeah, definitely. I mean, going to let's say 1031 exchanges, that is a benefit of holding real estate where, cool, if you put it in a retirement account, you can sell and you don't have the timelines of a 1031. But again, if you're already getting that benefit outside of your retirement account, kind of like putting municipal bonds in a retirement account where they're tax-free. Like if you get a New Jersey municipal bond and you live in Jersey, tax-free both federally and at the state. So why bother putting that into a retirement account?
Couldn't agree more. Awesome.
Yeah.
And one other thing I wanted to touch upon retirement accounts before we move on is the balance of actually when you do have the retirement accounts, like if you want to contribute to retirement as a real estate investor, how do you do that? And the only way to do that is to establish a sort of S corporation management company or C corporation management company that hires you to manage your personally held rentals, whether those be in tax partnerships or or just held individually, to then create and generate earned income through W-2 wages, to then go ahead and say, hey, if I want to contribute to a solo K, you can do that and get tax deferral. And then, like you said, it would just be investing in direct indexing there. Or if it was in the case of an IRA, you can invest in the S&P to provide diversification against your personally held real estate holdings.
Yeah, no, really good point on that. And then kind of switching gears here a little bit with some people are interested in using like their primary residence as a short-term rental for, let's say, if they go on vacation, or the World Cup is coming to Jersey next year in the Meadowlands. So for that final, I only live like 20 minutes away from the Meadowlands. So let's say that I decide to rent out my primary residence for a period of under 14 days, and I provide like some toiletries and food for the guests. How would the taxes on that work?
Yeah, I mean, the Augusta rule, I guess, is what we're talking about, right? Infamous due to the Masters. And essentially, back, I believe it was in the 80s, there was this new rule that was coming about because so many people that lived near the Masters tournament, they were always renting out their properties, right? So similar to your example that's coming up in North Jersey with the World Cup, you had all these people and they're going to rent out. So if you met certain criteria that were sort of loose criteria at the time, you were able to sort of have tax-free income. And now it's become more popularized and colloquially known as the Augusta rule. And essentially, if it's 14 days or less, any income that you earn is not reportable on Schedule E, right? Any expenses, though, incurred to generate and produce that income wouldn't be deductible because the income itself, the gross income from the rental, wouldn't be includable as income on your tax return. But there are situations where, let's say, you get a 1099 MISC or a 1099K or something that shows, hey, you received this rental income. You would have to report on Schedule E for matching purposes, but then you would adjust out all that income and write like Augusta rule or, IRC section 280 cap AG. So, and then say tax-free expenses, and then you would be able to report that correctly. So that's pretty much the intent of what that rule is.
Okay, so yeah, that's a nice little, I guess you could call it like a loophole of if you're going away on vacation and you want to make a little bit of side income, tax-free side income, just with the understanding that like any kind of things that you provide for the guest, you wouldn't be able to deduct.
Yes, and you have to be very careful not to go over 14 days, because if you do, then all that income is includable. But then you're subject to other rules, like essentially, because if it's a mixed use property and you're subject to the IRC section 280 cap A rules, which say you can't deduct anything beyond your gross income, then you're limited on those deductions. So it's kind of like a balance where you just want to make sure you hit that 14 days or less. And there's actually another application of this Augusta rule that is interesting, a little different from your example in, Rutherford, living in North Jersey, looking to rent to potential Europeans coming in to see the World Cup, etc. You could actually, if you're self-employed and have a partnership or C corporation or an S corporation that you work for employs you, and let's say you have personally held rentals, you can actually, if you have a justifiable business purpose behind and using your personally held, like your home, you can actually generate an expense on the books of your business that would be tax-free on your personal return. So you'd be generating a deduction to create even more tax efficiency. But like I said, you have to have a bona fide business purpose. Like you would have to have, like, let's say like a retreat, like a business retreat where you take your employees to your home and use your home for legitimate business reasons. And then you actually have a contract between your business entity and you that shows, hey, here's the exchange of services, here's the fair market value for those services. And as long as you meet that Augusta rule, you could generate some tax efficiency there.
Yeah, and I mean, even if you do wind up renting out your house for over 14 days, obviously not the end of the world. Can you talk a little bit about how like the prorating works on, what has to be considered rental versus personal use?
Yeah, so the way it works is it's, I believe it's the greater of 14 days or 10% of the total use of the property. So you look at that and essentially that triggers the application of the limitation, right? So if you meet that threshold, you cannot deduct any operating expenses up from the rental, such as, repairs, maintenance, utilities, insurance, interest, depreciation. You cannot deduct those in excess of the gross income received from that mixed use personal business rental, right? So that's one element to it. But regardless of that rule, if there's even 1 day of personal use, let's say I have a long-term rental, I rent it out 364 days a year and I use it 1 day a year, any overhead costs for the rental, which are the vast majority of the expenses on the property, will have to be prorated based on the business use percentage. In that case, being like 99.5 something percent.
Yeah. Now, as far as like utilizing losses from your short-term rentals to offset other income, I know we kind of touched on that, but can you talk a little bit about, what's allowed from your short-term rental, how you can get it to offset your active income, and really how that differs from long-term rental purposes?
For short-term rental, how it works is you just need to materially participate in that short-term rental. You don't have to meet another layer of statutory requirements, such as reps, right? Like we've talked about previously. So it's much easier, especially for someone who's a W-2 employee, who might be a tech employee, a high-earning tech employee. They may not even be in real estate. Maybe they just want to start having some exposure to real estate. So a fact pattern that really works with short-term rentals is, let's say you have, high-earning W-2 tech employees with high equity compensation. Maybe they had incentive stock options, or non-statutory stock options that generated a ton of ordinary income, or RSUs that may have vested during the year that generated a ton of ordinary income. And you can look at a short-term rental, take some of that equity, allocate it to a short-term rental, and if like we were talking about earlier, if the economic analysis makes sense, along with the tax advantages on the front end, to offset that high ordinary income is attributed to the equity comp, you're seeing big tax savings. And all you have to do is essentially materially participate 100 hours in that property every year and not be surpassed by anyone that you hire. So if you hire someone to repair, they can't perform more than 100 hours. So you have to make sure that you're performing 100 hours and that it's the highest amount of material participation hours of any person that may have worked on that short-term rental, whether it's an owner or an outside contractor or agent.
Or else it becomes 500 hours then, right? If someone
Correct. Then you look at 500. That's like the safest, easiest one to target. And then you have to look at, are these investor hours or are these actually operating the management property hours? Because if there are some investor hours count, but most don't count towards the actual hours needed. So it's really imperative to really hit the 100 hours, because really busy tech employees, what are the chances they have 500 hours in a given year to manage one property? It's very hard. So that's the short-term rental side.
So now, can you group together your short-term rentals, where if you have a few different ones and you want to get that 100 hours in, can you group them similar to reps for long-term rentals as well?
Correct. It's technically two different groupings. So two statutory law separate, but kind of function similarly. The long-term rental grouping is much more straightforward in that you look at, it doesn't really matter where your rentals are located. You're just making an election to treat all of your rentals as one rental. But there are caveats with that. That's an irrevocable election unless there's a facts and circumstances change. And there could be situations where, let's say you had suspended passive activity loss carryovers, and then you did a grouping election. There could be situations where a lot of those losses are locked up, and it makes it harder to leverage those losses, which can be leveraged for a lot of reasons in a positive way. So that's something to think about. And then on the short-term rental side, it's a 469-4 election, and that's more of a business grouping election, where as long as you have geographic interdependencies and functional interdependencies, and you can create a short-term rental portfolio that is intertwined and pretty much functions as one business, then you can do this grouping election, and then you don't need as many material participation hours. You can sort of have, hey, hey, I'm going to hit 500 hours and that's going to take care of 10 short-term rentals that I have in my portfolio that are all kind of intertwined. And then I'm making great cash flow, tax advantage cash flow for not as many hours.
Yeah, and then you mix that in with like accelerated depreciation, and that can offset a whole lot of your active income. So I mean, that's great. Like you said, we're someone working in the tech industry, making tons of money, RSUs, and then using that depreciation to offset their active income.
Yeah, exactly. And have you ever seen a situation where like people, even if they see all the tax benefits of the short-term rental, they still shy away from doing it just because of like the amount of effort? Like we're talking about all these hours, right? Like, is that something that really plays a part in their decision making?
100%. I mean, I could use myself as a case study where I have a long-term rental, and the reason why I'm not looking to pick up short-term rentals right now is just because how much involvement there is in the process. And, you know, I have a financial planning business to run. So that's been the main thought where, you know, in the next few years, I'd like to eventually pick up a short-term rental. But it's always, you know, weighted on my mind that, hey, there is so much more activity you have to do for it in order to really reap the benefits of owning short-term rentals.
Good point.
How about using, let's say you have a portfolio of long-term rentals and short-term rentals. Are you able to use the depreciation from both to offset each other, or how does that work?
So essentially, depreciation expenses get bucketed together as long as there's a bit of a caveat here. So assuming that you are a real estate professional and you have short-term rentals, you can fully leverage depreciation against one another without any sort of limitations, as long as you have basis, meaning you have equity, you've invested capital, after tax capital, and you have risk basis. Like you've actually, if there's any leverage, that leverage is attributed to qualified real estate, real property. So to be able to deduct all of those expenses and avoid limitations. So as long as that's the fact pattern, the answer is yes. But let's say the fact pattern is you have a short-term rental, right? Where you're going to pursue the short-term rental loophole. Let's say we were talking about that high-tech earner who's looking to leverage accelerated depreciation to offset their ordinary income. But let's say on the ancillary side, they have like 2 long-term rentals that have just been chilling there for a while, generating passive income, right? Well, that's the key. Since that tech employee cannot meet the rep standard, the passive income from the rentals, if they were generating losses, that would be limited and you wouldn't be able to leverage that depreciation necessarily against your ordinary income from your tech employment and versus the depreciation from the short-term rental.
Okay, yeah, and then sorry to reiterate, the long-term rental you wouldn't be able to use to offset, but the short-term you can still use the benefits from that on your active income.
Correct. Yeah, your depreciation would just be limited to the gross income from the long-term rental, and then anything in excess of that would be kicked out as a passive activity loss carryover into a future year and would not be able to be used until you have either a passive income, meaning income from long-term rentals, or let's say maybe you have a passive investment in a S corporation or a partnership that's generating a K1. That would also constitute passive income, and then you could absorb those passive activity losses, or you sell the long-term rental and that releases the passive activity loss to offset against the gain from the property.
Cool. Now, obviously, there's a lot of like ins and outs when it comes to short-term rentals. So, are there any like coming changes that might hurt or benefit short-term rental activity in terms of the tax laws?
Yeah, it's looking like there's a lot going on right now in the Senate. They're debating currently. Actually, they just released, I believe it's the Ways and Means Senate committee just released a draft of the bill, of their version of the bill, and it's a bit different than the House version. But essentially, 100% bonus depreciation is on the table in both versions of the bill. In the House version, it's pretty much between January 19th of 2025 through 29, but the Senate wants it permanent. Republicans in the Senate want it permanent. So it's going to be good for real estate investors in the medium to long term, assuming some version of this bill passes. So that's the big thing, 100% bonus depreciation. That's the easiest way to leverage accelerated depreciation to offset capital gains, ordinary income, interest income, etc. Pretty much every type of income, assuming you are a material participant in that short-term rental. And then a couple other things that are not as critical, but still important. Section 179 deduction is the cap is going to go up quite a bit on that. So that's a welcome change. And then QBI deductions, which are actually rental properties can use in many cases and short-term rentals can use because they are treated as a business. So that's looking like that's going to be made permanent in both versions of the bill. And then there's a few things that are negative, like the pass-through entity tax, which is essentially a mechanism to avoid the SALT cap or to mitigate the SALT cap, might be mitigated or changed quite a bit. So those that hold short-term rentals and partnerships, preferably not in S corporations, but if they were in S corporations, they'd want to monitor to see if there's going to be any changes to the PTET, and also things related to energy efficient credits, like the Section 179D credit, which is commercial energy efficient credit or deduction rather, and then EV credits, investment tax credits, solar credits, pretty much all that stuff that could have been used for business purposes potentially looking like that's going to go away. So probably in 2028 or beyond if anything passes.
All right. So it looks like some things might be getting better, other things not getting better, and in some cases a little worse. So it seems like a lot of it is kind of offsetting each other. Would you say that? I mean, especially if you have a building where, you're going for those energy efficient credits, but now you can no longer get that. However, because of the new, the 100% bonus depreciation coming back into effect, that might offset a lot of that.
Exactly. It's gonna pretty much rearrange the stack in terms of the economic analysis from a tax standpoint as to what makes sense. And effectively from a policy standpoint, yeah, they want to pay for some of these other new tax cuts with some of maybe the Biden era policies that they disagree with, that Republicans may disagree with, as a means to justify the expense of the other tax cuts like bonus depreciation.
And now looping back kind of to like mitigating those short-term rental risks, we touched on a bit of insurance and the economics of it, of how you have the off season. Another thing, I really like to touch on is as far as mitigating risk in, let's say, setting up an LLC for your short-term rental. Obviously, LLCs are not bulletproof. You see on the internet how, oh, hey, you just put it into an LLC, you don't have to worry about anything. That is not the case. I mean, if you follow the rules exactly and make sure that you have like separate accounts for it, money goes in, money goes out in a registered fashion, you're not commingling your personal funds, that helps to make it a little bit stronger where, God forbid, you do wind up getting sued from one of your short-term rental tenants. It makes it harder to pierce the corporate veil. One thing that a lot of people definitely need to know about is the due on sale clause, where you have a mortgage on the property and you're going to move it over to an LLC. Most mortgages have this clause in it called a due on sale clause, where even though you're not really selling the property, if your mortgage servicer sees that, oh, hey, you moved this over to an LLC, they have the right, if that clause is in your mortgage contract, to call the note due, which means that you would have to pay back the loan immediately. Now, I know just working with a lot of investors, that is very rarely enforced. I haven't heard of it being enforced. Usually you have to do something really stupid in order for the bank to enforce it. Myself, I've moved my long-term rental into an LLC, and the lender is well aware of that, and they had no issues with it. So just making sure that you properly make sure that everything is done correctly. You're not doing anything stupid that would raise up a whole bunch of red flags and have the bank say, we're just going to call the loan due. And then another thing is more so from like an estate planning perspective. If you're the one managing the short-term rental, what happens if you do get hit by a bus? Who's going to inherit the property? Are they able to properly manage it, or is the property just going to fall apart? So properly setting up a trust and maybe moving the property into an LLC held by the trust, so that if you were to get hit by a bus tomorrow, it can quickly move to your beneficiaries and they can take care of the property. Because, and I'm sure as you've seen many times, if someone dies without like a proper estate plan and they got rentals, it's got to go through the whole probate process, and it's based on where that property is located. So some states have a better probate process than other states. So you definitely want to make sure that you're properly protected from an estate planning point of view. And another cool thing is that some states, like for Jersey, they don't allow this, but I have a client with short-term rentals in North Carolina. The properties are held in her mom's name, but there's a TOD on the deed, so transfer on death, where when her mom passes, the rentals are going to transfer into my client's name. So that's a case where, hey, you don't have to go through all the expenses of setting up a trust. Some states just allow you to quickly transfer over the real estate to your beneficiary.
And would that beneficiary receive a step up in basis on the underlying on that property that they're inheriting in that case?
Yeah, so you get the step up in basis and everything. So if you wanted to turn around the next day and sell it off, you could do that, not have to worry about paying any capital gains. For the client I'm talking about, she wants to keep, because it's a really good cash cow, so she wants to keep running it. But yes, that is a option that you do get that step up in cost basis, which is huge.
And you get more depreciation deductions too, right? When you get the step up in basis. So if, like in the case of your client, if they want to continue renting it out, you get the cash flow plus the tax advantage of the new stepped up depreciation based on the updated fair market value.
Yeah. So if you bought like a property, in the depths of the recession that has appreciated a ton in value, your heirs get it at a stepped up up cost basis, which is awesome benefit. And I mean, it's not just real estate. Obviously, like brokerage accounts, you get a stepped up cost basis as well. But it just adds further fuel to the, wow, look at how tax efficient real estate is. That's actually a good segue into, on your end, what are some things that people can mitigate risk with, like from a tax standpoint on their short-term rentals?
The primary thing is making sure you're maintaining contemporaneous logs that are noting your activities, the amount of hours in that activity, and the actual short-term rental assigned to that activity. So essentially 3 attributes that you want to track on an annual basis so that, come tax time, you have the hours, they can be quantified and your accountant can file, and you can take advantage of those accelerated depreciation deductions on your return where it lives and it's native. So that's really important. And if, God forbid, there was any sort of audit from the IRS, and they do look at short-term rental investors quite a bit to make sure it's, done properly, they would want to make sure that you're meeting that quote unquote loophole, which is essentially not a loophole. It's just guidance from the IRS, specific guidance that they came out with quite a bit ago. And essentially you just want to meet that. And by having the contemporaneous log, you can do that. You don't need a contemporaneous log, but it's the most bulletproof mechanism to document and substantiate your hours. There have been court cases where there have been people, taxpayers who try to retroactively create their logs, and then they're essentially thrown out because it's BS. Like, they overstate their hours, obviously, because they're trying to hit a target rather than build into the target. So
yeah, that's a good point where, like, hey, you know what, keeping current logs is kind of a pain in the neck, but when you get, or if you were to get audited, it's like, whew, okay, good, because the last thing that you want to be doing is kind of scrounging for, okay, what kind of proof can I provide to the IRS that I actually did all of this?
Exactly. And then plus you can essentially reduce your representation fees if you have the documentation up front, because all you have to do is submit the documentation and respond to a letter and just deal with the process, rather than now starting from scratch. You need real representation. We have to build documentation, and it costs a ton to hire an accountant or a tax attorney for those types of representation services. So you're doing yourself some savings in the long run.
Yeah, definitely. So, hey, Gio, thank you. This was like a really informative. I'm sure everyone thinks that, I mean, tons of value here. So for anyone who wants to talk with you about their tax situation, can you just go into how they can contact you?
Yeah, absolutely. All they have to do is visit our website at gojoaccountants.com and submit just a free consultation link for us to learn just a little bit about you, and then we'll reach out to schedule a meeting, and then we go from there.
Well, hey, thank you again, Gio. Really appreciate you coming on, and looking forward to the next one.
Same, Angelo. It's always a pleasure. Take care.
Bye.